All right, let's get you up to speed on how the markets have been unfolding in this Tuesday trading session. Alan Nuckman's chief market strategist at Agora Financial. Alan, I'm looking at a mixed picture here right now. The S&P dipping into the red, the NASDAQ as well, the Dow holding in. But initially this morning we saw a negative performance, then a positive open. It's as if the bulls really want to stay in the mix right now. What's been your interpretation of the market flows?
Well, it's hard not to be optimistic. I mean, call this a comeback. Last week's action, and then we took out the lows on Thursday and bounced back. All very, very positive. And let's remember, we're 1 year away from, the market downturn that we saw and a complete comeback. So there are so many positives here. And I'm looking for the market to attack these recent highs one more time. But my target's been 4,000 in the S&P. Just from the range that we had last year, where we traded between 3,200 and 3,600, that target's 4,000, and we got very, very close. We'll have to see.
Yeah, about 100 points or so away from where we are right now, and we do see the Dow outperforming right now. I get the conversation around where investors want to place their bets. What's the general I guess, philosophy that you're living by right now on the sectors that will outperform if stocks do keep climbing?
Well, what's important to me is we've seen a complete comeback in stocks, but more important than that is that we've seen the commodities come back. And there were a lot of resource stocks, and especially oil, with that whole kerfuffle that we saw in oil where it actually went negative just because of the way the expiration unwound and they had some people trapped. But since that time, it's gone from 0 to 60. That's very, very much a positive. And I thought last, November, when crude oil broke out, that was more of a positive barometer than anything, because then all the energy stocks have come back, and that's been the lagging sector. They're still, I think, 25% off, but there are a number of stocks out there that I like that haven't really rallied. Let's talk about America, and for me, when I'm looking at the American market, I'm looking at Apple. Apple's still 10% off its highs. Yesterday, it was 15% off its highs, and the highs were only made a month ago. So if you believe in the market, you've got to believe in Apple. And technically, I love the risk reward. Again, I'm an options player. But it's important to know that the big tech companies have not led this latest leg in the stock market. So I think they can get a little bit of momentum going when they do move.
Well, you're absolutely right about that. I mean, you look at the S&P 500 performance this year, you see energy right at the top of the list, you see tech lagging, and then you've got financials that have also outperformed technology. We've gotten a lot of commentary so far this morning about that group. Obviously the jitters we saw in the stock market because of rising bond yields, it actually opens the door to a conversation around whether or not profit margins are going to start looking a lot sweeter for the banks if we're talking about higher interest rates. How do you view that sector right now?
All right, well, the banks make money no matter what. Okay, if you looked at the last couple of quarters, we're talking $5 billion, $8 billion, $9 billion profit for the quarter for some of these banks. Okay, so let's not cry over the spilt milk here. Now, yes, the financials still have not recovered completely from the 2008 financial crisis, so they still have upside. But I think what's important is we kind of glossed over the fact tech has led for years, and I imagine it's going to continue to lead. But I think that is a sector move that we could see kind of come back one more time. So I like how a lot of those companies are set up there. The financials, obviously, the banks have had their breakout. The energies have had their breakout. It's a matter of momentum. If you want to get into the Dow, which is only 30 stocks, or Dow-like stocks, these are stocks that were in the Dow, I like two old school companies. I like X. I like U.S. Steel. U.S. Steel paused after it had a 400% run. It dropped, and it was about 25% off its recent highs. I love the technical setup between 15 and 25, leaning on the 15. And the other stock that I really like is AT&T. Nobody likes AT&T. I like it from a risk-reward standpoint. It's stuck between 26 and 32 for the last year. It hasn't been below 25. I'm looking at 25 calls. It hasn't been below 25 in a decade. Now, you look at AT&T, who knows what's going to provide a catalyst, but this sideways range is usually indicative of some sort of a breakout, and I love the risk-reward looking at some July options on that.
Okay, some names to watch for. Just more broadly speaking, the S&P 500's rally in this bull market. I mean, if we're going to go back to March of last year when market nervousness was sky high, we basically saw that bottom, and since then we've really rocketed ahead. Now we're showing our audience right now a chart that our colleagues at Bloomberg were flagging, Alan, which shows the S&P 500 after the start of bull markets, this one, but also 1982 and 2009. And we picked those ones because those arguably are the two fastest starters that we've seen since this current advance. And then you get to basically the 1 year mark, and then in those past instances, you've got a 6-month period where the S&P is either little changed or lower. So in this environment where there could be some more momentum for stocks, there could be some outperformers. Should you also be prepared for the reality that after big run-ups, it's not a surprise to see some pockets of the market go sideways?
Oh, definitely. You always have to be ready. And I call these profit-taking pullbacks, and you want to be able to take advantage of it. There's always stocks that don't participate. Those are the stocks I like, and that's where the ones I've mentioned here recently that I'm comfortable with because they haven't participated. They haven't led the rally, so to speak. So I think that's important. But let's get back, and I kind of glossed over. You talked about the bond action last week. Now, we've seen this recently. This is an exact repeat of what happened a couple of years ago when the 10-year yields went up to 2%. Everybody thought that it was up and away from there, and everything was, that rates were just going to climb, and everybody was worried about inflation.
Yeah.
Deja vu all over again. Last week, we got up to 1.5%. Let's remember the low was 0.5%, and the high in the last 10 years has been 3.5%. So the midpoint is 2%. We're still at absolutely ridiculously low interest rates. So the talk of inflation and the talk of things getting really hot really fast, I think we're overblown. And let's see what the market says. But there is no choice right now between going into stocks and finding yield or going into treasuries and finding the yield, even at 1.4%. It's really not even a conversation.
It's helpful context, and it is great to look back at the market charts in that 2018 period versus now. Hey, Alan, thanks as always. Good to get your insight and analysis on this Tuesday morning. Alan Nuckman, Chief Market Strategist at Agora Financial.